of color. We are really excited about this event. This is a topic that we're very excited to bring to you and share some information on. We have some excellent speakers today. So before we get going, I just wanted to share a little bit about the partnership and also some housekeeping to get you settled in for the event as folks are still joining. As I mentioned, my name is Kylie Goslin. I'm the Executive Director here at the Partnership for Strong Communities. And for those of you who don't know us, the Partnership is a policy and advocacy organization dedicated to ending homelessness and expanding housing opportunity here in the state of Connecticut. IForums, these events that we hold quarterly here at the Partnership, are free public education forums where we bring together both local and national speakers to share ideas, inspiration, and innovation. I especially want to thank our sponsors today. You'll see those noted at the bottom of your screen: the Connecticut Department of Housing, Connecticut Housing Finance Authority, our presenting sponsor, Liberty Bank, and of course, Melville Charitable Trust. I also want to give a special shout out and thanks today too to Bill Graustein and the Graustein Foundation, as well as the Hartford Foundation for Public Giving, both of whom have been funding much of the research and especially our Young Writers Program, which Ms. Giraldo, who's joining us today, participated in. The Young Writers Program is a new program that the Partnership has started to highlight and amplify voices of BIPOC young writers on topics of housing, homelessness, and community development. We are paying writers, working with them, and helping them to publish their works. So if you are interested yourself or know others who might, please visit our website, pschousing.org, to find out more information about that program. Today's topic was, as I said, born out of the research of Ms. Giraldo, who's joining us as our second keynote today, and is a really, again, exciting topic that I think you're hearing more and more about. We'll be highlighting some of the gaps that currently exist in wealth building opportunities in communities of color, where programs designed to ameliorate that are succeeding and failing, and how we can do better. I want to just note some housekeeping, as I mentioned, before we get started. So all participants are on mute for the full duration of the program. This event, as you may have noticed, is being recorded, and it will be available on our website after this event is done. So pschousing.org, if somebody else you know is interested but wasn't able to join us today, it will be there shortly. Also, for purposes of questions, if you have questions, please put them in the chat and direct them to the meeting host, which is PSC Zoom Meetings. Again, if you have questions throughout the program, please put them in the chat window. We'll be working to address those as part of the panel discussion that Julian Pierce, our moderator, will be moderating during the second half of this presentation. Finally, we aim to keep these presentations, as I mentioned, free. IForums are free public events. However, if you'd like to contribute and help keep them free, please, again, visit pschousing.org to do that. Every little bit helps, as always. So before we get started with our keynotes, I wanted to tell you a little bit about them. I know their bio information is available, as well as the speakers for our moderated panel. But our two keynote speakers will be Dr. Jenny Schuetz with the Brookings Institutes and Thalia Giraldo, currently with Trinity College and formerly graduate of Trinity College Graduate School. I will give you a little bit of information about Thalia first, and then I will hand it off to Dr. Schuetz after I give you her biographical information as well. So as mentioned, Thalia is the first published writer in PSC's Young Writers Program, but she's no stranger to housing issues. During her time as a graduate student at Trinity, she worked closely with her peers and also with the Partnership, writing about issues related to multifamily housing policy, finance and equity, and mixed income housing. She also has written about home ownership assistance program, and her most recent publication as part of our program is called Building a More Equitable Home Buying System, and it's available at pschousing.org under our publications tab. Thalia is currently the Associate Director of Innovation Initiatives at Trinity College. She earned her bachelor's in sociology and Latin American studies from Colby College, and as I mentioned, her master's in public policy from Trinity College. So she'll be joining us shortly. But our first keynote speaker we're excited to have today is Dr. Jenny Schuetz with the Brookings Institute. She's a senior fellow with Brookings Metropolitan Policy Program and is an expert in urban economics and housing policy. She was previously a principal economist at the Board of Governors of the Federal Reserve System. And her recent research has focused on statewide zoning reform and housing affordability, a topic that is familiar to probably many of you watching here in Connecticut, as well as rethinking homeownership incentives to narrow the racial wealth gap, as we're talking about here today, and how housing costs exacerbate economic and racial segregation. She holds a PhD in public policy from Hartford and a master's in city planning from MIT, along with a bachelor's in economics from UVA. Woo, that's a lot. We're so excited to have her here today. So without further ado, I'm going to hand it off to Dr. Schuetz to take us through her presentation and kick us off. Thanks for joining us.
Thanks very much to PSC Housing for having me, and thanks for putting on this event on a really important topic. I have a couple of slides to share with all of you. All right. So I'm going to give a little bit of national framing to homeownership and the racial wealth gap to set up Thalia's really important report that provides some more local context for this. So to start with, why do we talk about homeownership so often in terms of wealth building? It's because home equity is the largest financial asset for the vast majority of middle-income households. So this is showing you the entire US population divided into 5 equal categories by wealth. And you can see that higher income households are more likely to own their home, but home equity is actually a smaller share of their total assets. So very wealthy people are likely to have more of their money in things like stocks, or they may own a family business. For middle income households, home equity really is most of their wealth. So you can see for the 3 middle income quintiles that home equity is more than half of their total net worth. So this is a very important asset. And when we talk about wealth building for most people, it really involves how much money they have in their house. Homeownership has some very distinctive pros and cons in terms of wealth building. And we want to think about this both for individual households and for sort of larger communities and society. So the strengths are pretty well known. One is that you can buy a house without having to have all of the money upfront in cash, right? So most people borrow money in order to buy a house, which means this increases the value of the house that you can acquire relative to your income. You can't, for instance, borrow money and take out a mortgage to put money in your 401k, right? So leverage is one of the key pieces. And in particular, the federal government has gone to enormous trouble to construct a mortgage system so that mortgages are cheap for most households. Implicitly, there's a subsidy attached to the interest rate. It's much cheaper to borrow money to buy a house than it is to buy a car or put money on your credit card or student loan debt. So the federal government is subsidizing Americans to buy homes, which makes that a good deal relative to a lot of other assets. Probably most sort of recognizable is that homeownership has a forced savings mechanism built into it. When you buy a house and you take out a mortgage, every month you pay the bank the same amount of money. And some of that goes towards interest, which is essentially fees for the banks, but some of that goes towards equity. And over time, you build up a little bit more equity every month, and that becomes essentially the savings that you can tap into. So you don't have to make a decision consciously month by month how much you want to put into a savings account. It's just built into paying off the mortgage. So that forced savings mechanism is a really powerful tool, and we want to think about how we can apply that maybe to some other kinds of asset building. It's also important to realize that for homeowners who have a 30-year fixed rate mortgage, which is standard in the US, your monthly housing payments are fixed for a very long time period. That's really important. Even if you're not building up equity, it means that you know how much you have to spend to stay in your home. That's very different from renters who have a year-long lease. And when the lease ends, the landlord can raise the rent potentially by more than your income is going up. Right? So that's actually separate from the wealth building, but it's just about financial stability. And again, that's a really strong benefit to homeownership. On the limitation side, one of the main concerns is that all of your money is sitting in a single asset, right? So the flip side of homeownership is a big part of household wealth is your house has all of this value tied up in it. If, for instance, you live in a community that's oriented around a single industry, say the insurance industry or car manufacturing, if that industry takes a hit, then the value of your home is likely to go down. And that's likely to happen at the same time that jobs become more scarce in your region. So this is not a diversified asset, and there's the potential for people to lose a lot of money in their house. Those of us who remember the Great Recession know that, in fact, that happens. Housing prices can take a tumble. People can lose an enormous amount of wealth that they have been trying to build up for many years. And that's something that doesn't happen the same way with a stock portfolio, where you have different companies that balance out over time. Another important limitation is that money in your house, home equity, isn't like money in a piggy bank, in your savings account, or even in a stock portfolio that you can just pull out when you need it. There are ways to tap into equity in your house, for instance, a home equity loan or line of credit, but it's not that easy to just take out a home equity loan overnight. People who have weaker credit scores may have trouble accessing their equity, and this is particularly hard to do in a downturn where the value of the house goes down, right? So although the money is there in some sense, you can't access it. And if you need to do something like fix your car in order to keep getting to work, or you have a short-term medical emergency, that money is not really available as cash, right? So we want to think about what some of these limitations are with homeownership in order to think about how we could complement that with alternative forms of home building. One of the other sort of social concerns that we worry about quite a lot, and that we're going to talk about more in today's program, is that homeownership is actually a very big contributor to the racial wealth gap. We know that over the entire history of the US, Black families in particular have been discriminated against in real estate markets, both in their ability to take out a mortgage, in the kinds of houses that they are shown, the ability to buy into neighborhoods that are likely to appreciate. So Black and Hispanic homeowners are less likely, or families are less likely to own their own home than white households of equivalent income. And if they do own a home, they tend to have less equity in it. So this is showing you that there's a substantial gap in the percentage of homeowners between Black and Hispanic households and white households. And the typical Black homeowner has less than $60,000 in home equity compared to $100,000 in home equity for the typical white homeowner, right? And this, because this is built up over generations, even if we were to eliminate all discrimination in housing markets tomorrow, there would still be this enormous difference in existing wealth gaps. And getting rid of discrimination will not fix that. So if we care about the racial wealth gap, we need to think about things other than just encouraging Black and Latino families to buy homes, right? We need to think about more direct strategies. One of the reasons why there is so much of a gap in homeownership is that Black and Latino households have less liquid savings. This is some of the money that they are maybe saving up for a down payment. So we see, again, this very big difference in whether Black and Latino households have any liquid savings at all, and if they do, they have much less, right? So there's just not a lot of money. This is also a really important thing to consider. Buying the house is only the first expense. Once you get in the house, you have to continue paying not only the mortgage and the property taxes and insurance on it, but maintain the home, right? And if you don't have savings set aside beyond the down payment, the first time something in your house breaks, you're short of money and you're living in a house that then has some maintenance problems. It's especially true in places like Connecticut, where the housing stock is older, and older houses just require money to maintain them in good working condition. So what are some ways that we can think about wealth building outside of homeownership, both to balance out some of these limitations and to address the racial wealth gap more directly? One thing is that the federal government really ought to consider our current tax incentives for homeownership, which overall subsidize high-income households who would own their own homes regardless. It encourages them to take out more leverage, and overwhelmingly, the federal tax benefits of homeownership flow to very high income households and mostly to white homeowners. So there are many proposals for how to restructure this. The general idea is that rather than giving an annual subsidy to people who own homes at very high value, you would give a one-time upfront subsidy to people who are currently renters who are buying their first home, and you could make that fully refundable. So essentially we're giving something like $15,000 or $25,000 to first-time home buyers to help them pay for this cost of getting into home ownership rather than having this be for the lifetime of the loan. So that would be one thing to do. The federal government could save quite a bit of money by doing that, and it would enable them to subsidize other forms of wealth building. In particular, things like baby bonds or individual development accounts. These would be tax subsidies to provide essentially a pot of startup money, some seed capital to families that don't have a lot of wealth. So baby bonds, the idea would be to give a chunk of money to every child born in the US, and they could accumulate that money until they were 18 and then be able to tap it, for instance, to pay to go to college or to start a business. Individual development accounts, again, you would give some money to adult families and match their savings and contributions. There are a variety of ways that we could structure programs like this, but it's really important for all households, both renters and owners, to have some amount of liquid assets, and using the tax code to match that rather than primarily for high-income homeowners would be more equitable, would help eliminate the racial wealth gap, and would mean that everybody has money to fall back on during a rainy day. So we can talk more about some of the details of these, and I look forward to taking your questions when we get to the Q&A part of the presentation. Thank you.
Thanks, everyone. I'm going to turn it over to Thalia Giraldo to give us a Connecticut perspective.
Oh, I was on mute. I'm going to go ahead and share my screen as well. All right. Good morning, everyone. As Kylie said earlier, my name is Thalia Giraldo, and I'm so excited to be here with you today to talk about my report on homeownership assistance programs that I've been working on for the past year, but really a little bit more than that. So before we start, I wanted to give a little background into who I am. So I am currently in my day job the Associate Director of Innovation Initiatives at Trinity College. So what that means is that I help Trinity College implement innovation and tech-related projects and partnerships. So some of you might know, who are familiar with the Hartford area, that Trinity got into an exclusive partnership with Infosys a few years ago to help bridge the gap between technology and the liberal arts. So it's really exciting work we do. And as someone who is born and raised in New York City, I am super passionate about making the city of Hartford a thriving place where young people want to live and work. So really, really fun stuff that we're doing at Trinity. I also received my master's of public policy from Trinity College from the public policy program. And it was here where I really did start to work on the homeownership assistance program report that I'm talking about today. So in the capstone project that I worked on with the partnership, I explored the financial tools that existed to create mixed income housing right here in Hartford. So I was looking at what kinds of tools would be available to support the development, preservation, and ownership of homes in this area. And then after I graduated, I actually got tapped by the Partnership for Strong Communities to be part of the Research Associates program, which Kylie mentioned amplifies the voices of young writers of color who are interested in doing housing research. So I was so honored to be continuing the work that I did in my master's program, and I helped them build a database for all these financial tools that I had been researching. And it was here where I started to see the patterns in the strings attached that were attached to these programs that were intended to support the development and preservation of homes, but in fact, actually burdened folks when it was time for them to use these programs. So let's go through a little bit of what I'm going to talk about today. So my research is going to be, or my presentation is going to be divided into 5 parts. So we're going to start talking about some of the drivers of the racial wealth gap. So things like the GI Bill, redlining, and zoning ordinances. Then we'll talk about some of the more current disparities in homeownership today. So earlier, Dr. Schuetz was talking about how even if we were to remove some of the racial discrimination in housing, a lot wouldn't change. So I want to talk about some of the more current sort of implicit ways that racial bias plays into homeownership. And then part 3, we'll talk about the role of the homeownership assistance programs and all of the strings attached that I found in my research. So this is really the meat of the presentation. And then I work in education, so I love using exercises and activities as a way to facilitate learning. So we're going to do a little exercise into what it would be like to buy a home using homeownership assistance programs. And then finally, we'll take a look into building a more equitable home buying system and what that looks like, and some questions to consider. Okay, so in order to understand our current homeownership assistance program, it's really important for us to take a step back and look at some of the more historical influences. So policies and programs that followed World War II played a really big role in setting the foundation for some of the racial segregation that we're seeing today. And one of the most impactful of these programs was the GI Bill, which is a homeownership assistance program. So in response to the struggle that vets were facing after the war, President Roosevelt passed a comprehensive package to support veterans who were returning to civilian life. And this touched upon housing, employment, medical, and educational needs. And in our case, the GI Bill really impacted housing. So some of the more details of this program is that folks who were able to use this program had guaranteed loans of up to $56,000 worth today, and really low interest rates. And in fact, the government paid for their interest rates in the first year. There were no strings attached to this program. It was an understanding that vets were coming back from a really difficult situation. They had no jobs, and they were coming and readjusting to civilian life. So there were no strings attached to these programs. And in essence, because of that, this homeownership assistance program really created the middle class and started for a lot of people the concept of generational wealth. But like many things of this time, this too was plagued by racism. So women and Black, Indigenous, and people of color, which I'll refer to as BIPOC moving on, were often denied mortgages and prohibited from purchasing in the suburbs. So they often were not allowed to even access this benefit, which they should have received because they were veterans coming back from war. So not only were BIPOC people denied the GI benefits of this time, but then there were also structural things that made it really difficult for people of color to access buying a home and buying a home in a high opportunity neighborhood. So things like zoning ordinances, which rule how property in specific geographic zones can be used. So whether an area can be only single family homes or only commercial buildings. This has really held historic goals, specifically by not allowing multifamily homes, which are mostly occupied by lower income and people of color, by not allowing multifamily homes from being built near single family homes. And this has been an effort to keep lower income people away from middle class neighborhoods. So as the GI Bill helped to help veterans buy homes, and zoning ordinances kept white homeowners in exclusively white neighborhoods, then redlining adds another layer to the effort of structural racism. So redlining is a practice where lenders would physically color code neighborhoods based on race in order to indicate where it was safe to insure mortgages. And neighborhoods that were primarily made of communities of color were circled in red and then deemed unsafe to insure. And this practice systemically denied mortgages to people of color, furthering them from the opportunity to access homeownership and build wealth. So while today, no one is saying that they're going around practicing redlining or other discriminatory practices, at least I hope not, today's discriminatory practices are a lot more insidious. So as Jenny mentions in her written article, today's discriminatory practices can be really hard to prove, especially in the home buying process, unless you take the time and effort to conduct some type of test for yourself. So last year, the New York Times broke 2 stories that exposed the implicit bias that is present in the appraisal process. One that took place in Florida and one that's actually right here in Hartford. So in the first case of the Florida story, there was a mixed race family, the wife who was Black and the husband who was white, who went in for an appraisal and received a surprisingly low rate. So they decided that they wanted to conduct a test for themselves. So they requested a second appraisal process with a different person. And the wife who was Black removed herself from the appraisal that day, and they took down all of the family photos that were present in the house, and only the husband who was white was present for the second appraisal. When they received their second appraisal, their home value came back 41% higher than the original amount, which is very high. So they were frankly, discouraged. And the New York Times covered this article, and it got a lot of press. So similarly, and in that same article, there's a Hartford case. So there was a Black man who was going in for an appraisal, and similarly noticed that his appraisal was surprisingly low. So he decided to conduct his own tests. He removed all the family photos of him that indicated that there was a Black person living in the house. And he actually had a white friend stand in for him at the appraisal. And the value of his home increased by $40,000. So this type of racism, which can happen on a large scale, goes unnoticed oftentimes, but contributes to our neighborhood's decline and fuels the racial wealth gap. So it's no surprise that today, the net worth of a typical Black family is around $17,000, which is only 10% of that of a typical white family. And this can be attributed to generations of being left behind, generations of being denied access to wealth, generations of being denied mortgages, being denied the opportunity to live in high opportunity neighborhoods, and being shortchanged and undervalued constantly. And we know, right, that homeownership is a key way to build wealth, especially for folks that are in the middle class and lower middle class. And historically, this has been how people in this country have built wealth. So we do need to educate and encourage people of color to own their own homes, but also to expand into other wealth building opportunities. So again, it is no surprise that only 41% of Black families in the United States own their own homes, compared to 71% of white families who own their homes. So how do we do that? How do we encourage homeownership and promote that for the people who need it the most? So the meat of my presentation and the meat of my report has been about homeownership assistance programs. And homeownership assistance programs are run by federal, state, and local governments, sometimes by nonprofits and organizations, and large employers like colleges and hospitals. And the goal of these programs is to remove barriers for potential home buyers who can make the monthly payments. They are financially stable, but they just haven't been able to save this huge lump sum amount for a down payment, which we know is just increasing and increasing over time. Saving for a down payment is the biggest barrier for people who are trying to buy their own homes, in addition to credit scores. So homeownership assistance programs really have the potential to help people further and reach this goal. The average down payment for first-time home buyers is only 7%. So we know that most people aren't putting down, or a lot of people aren't putting down 20% towards a down payment. So homeownership assistance programs are really impactful when they can be used in more comprehensive ways. So I want to start talking about the sort of strings attached that I found when I was doing my research. And the first string attached that I want to talk about is PMI. And the reason why I want to talk about private mortgage insurance first is because this is the most common type of string attached that lower income borrowers will see, and it's become a given sort of unquestionable fee, but it's applied in a really restrictive manner, and over time can really add up when we start to use different homeownership assistance programs together. So private mortgage insurance is an insurance fee that you will pay when you put down a down payment of less than 20%. And it is meant to protect the lender, not you, in case that you default from a loan. And it is applied to all kinds of loans, but I'm focusing right now on conventional and Federal Housing Administration loans. But they are applied very differently in each case, and especially with Federal Housing Administration loans. I'm going to refer to them as FHA moving forward. So FHA loans are a lot easier to qualify for because you need a lower down payment and lower savings. So they're often really popular with lower income people and first-time home buyers. So when PMI is applied for a conventional loan, let's start on the left side. So when it is applied for a conventional loan, if you put down a down payment of less than 20%, you will have a PMI fee monthly. And it is removed once you reach 20% of equity on the home. In the case of an FHA loan, if your down payment is less than 10%, it is applied for the life of the loan. So you're going to be paying it until you pay off the loan. If your down payment is more than 10%, then you're only paying for it for 11 years. And PMI with an FHA loan is paid monthly, plus there's an upfront fee at the beginning. So as you can see, FHA borrowers who are using FHA loans are paying more in monthly fees, but they're also paying more for a longer time. With a conventional loan, you're forgiven after you have reached the 20% of equity on your home, but that is not the case with an FHA loan. So why am I talking about FHA loans so much? So the reason I am is because FHA loans, 40% of people who are using an FHA loan are also using some type of down payment assistance. So they are seeking out support for a down payment in addition to getting a loan, which is easier to qualify for. So again, these are folks who may be able to make the monthly payments, feel like they're financially stable, but they still cannot reach this huge lump sum for a down payment. So they're going through other methods to find additional assistance. In the case of state and local programs offer down payment assistance as well. And one form in which this looks like is loans. So some loans that state and local programs offer will cover a partial or sometimes a full amount of a down payment. And the down payment is financed through a second mortgage, which users will pay interest on. So this would have to be used very strategically, and a lot of education is needed in order to ensure that users know what happens when they are financing their down payment. As we could see in the previous slide, if your down payment is less than 20% and you are using an FHA loan, there's already two different fees that you're going to be paying, the upfront PMI and the monthly PMI. And then if you finance your down payment, there is an additional interest that you're going to pay on that down payment. So that's 3 additional fees that you are going to get if you decide to finance your down payment through a state and local program. Local programs and sometimes state programs also offer grants, and these grants are essentially free money, and we'll get to that. And they may require home buyers to purchase homes in designated areas, so a certain zip code or neighborhood. And sometimes they may require an employer to stay employed at the institution if it is your employer who's giving this grant. They may require you to be at that job for a minimum number of years, or you might be required to own or occupy the home for a minimum number of years, right? So there's no such thing as a free lunch. There's no such thing as free money. So in this case, right? So you would be getting a grant from your employer or a grant from a community organization, but there are some strings attached to that you need to consider when you're planning out further. Okay, so like I said earlier, I work in education, so I love exercises and activities as a way to facilitate learning. And so we're gonna go through a exercise of what it would be like to buy a $200,000 home using homeownership assistance programs and without using homeownership assistance programs. So on the left side, we'll start with the person who is not using a homeownership assistance program. So usually, if you don't need a homeownership assistance program, that is probably because you can pay either a 20% down payment or there's no need for you to go searching for additional money. So this person is able to put 20% down, and because of their credit score and their savings, their APR is a good amount. So they'll have a 4% APR. They were able to put down a 20% down payment, so they're not getting charged PMI, the monthly one, and they're not getting charged a upfront rate. They didn't need to finance their down payment, so there's no additional fee for a down payment, and they can move freely, right? They're not restricted to buying a home in a particular area. They're not restricted to staying there for an amount of time. The total cost for their interest and fees is about $114,000 just in interest. So I'm not looking at paying back the entire mortgage, but just in interest, it's $114 for that. And their monthly cost would be around $763 for their monthly mortgage with all of the interest involved. On the flip side, let's say that we have someone who is interested in using a homeownership assistance program in order to buy this home. They were able to gather up $15,000 of their own money, and they used a homeownership assistance program that gave them $10,000. And they are going to be financing this, and they're also required to stay in the home for a minimum number of years. And they were required as well to purchase the home in a particular area. Because they probably went for an FHA loan, they're a first-time home buyer, and they don't have that much savings, their APR is going to be a little bit higher, so 5%. They are going to get charged for the private mortgage insurance, and that's the average of that is about 0.8%. They're getting charged as well the upfront PMI, which is 1.75% of the loan amount. And I looked up a local down payment assistance program, and the interest rate on that is about 1%. So totaling all of those things together, the interest that this person will pay for their home is $181,000, or around $181,000 just in interest. So this is not the mortgage, but this is just interest that they're paying. And the monthly cost of their home plus the interest is going to be $1,227.04, which is almost a $500 difference. So as you can see, people that are using these programs are actually paying more over time and more in a monthly cost in order to purchase their home compared to someone who did not use these homeownership assistance programs. For lower income people, a $500 additional cost is a large amount of money. And it might be okay for borrowers who are prepared for this, but sometimes in an effort to try to buy a home, to try to accelerate your wealth building process, folks do want to buy a home, and they see that as a golden ticket. And oftentimes, once we add all of these additional homeownership assistance programs, that is not the case. There's a $500 difference here, which is not a small difference. So now that we understand a little bit about the history, we understand how implicit bias contributes to the racial wealth gap, and we know what current homeownership assistance programs look like and some of their opportunities, or some of the ways in which they can burden their users. How do we build a more equitable home buying system? So there are 4 questions that I would ask any folks who are using or administrating or planning homeownership assistance programs to consider when they're building these programs. And the first one is, does the policy or program penalize low to moderate income people for charging them a fee, or adding an unnecessary requirement in order to use the program benefits? So the question here is, are these strings attached necessary? Is it absolutely necessary for this person to buy a home in this particular neighborhood or stay employed at the institution for an X number of years? And this is really important because I think in some cases we are requiring lower income people to only buy homes in lower income areas in an effort to revitalize the neighborhood. But if we're adding so much to their monthly costs, we're actually not helping them get ahead. And we're in fact contributing to even more racial segregation. The second question is, does the policy or program add to the user's monthly expenses, making their monthly mortgage more expensive and therefore less affordable? And like I said before, there is no such thing as a free lunch, and in this case, there's no such thing as free money. So they get an upfront benefit, but then on a month-to-month basis, they are strapped for cash. They're able to get their foot in the door, but at what cost? And in order for people to move forward and build wealth, we need to be able to minimize their monthly cost, not increase it. Third, does the policy or program restrict the user's ability to choose where to live and where to work in a way that may hinder them from pursuing better opportunities that can lead them to financial stability? In this case, right, we are requiring folks to work in a place for a certain number of years, or requiring them to own or occupy the home for a certain number of years. And that is fine if someone chooses to do it. But what if they get offered a higher paying job at a different institution or a different company? We're not allowing them to have the financial freedom that people who aren't using this program do have. And then finally, and most importantly, does the policy or program work to correct or undo the historical effects of systemic racism. And this question asks, can we take our policy or program a bit further to actually target this to BIPOC people that have been denied access to homeownership for generations? Today, we're facing an economic and racial crisis that needs intentional intervention because we see the ways that implicit bias work and we see how hard that is to prove. So can we find a way to support aspiring BIPOC homeowners through targeted financial support and education? So breaking the cycle of poverty for people starts with providing choices that empower them for financial independence and in order to build generational wealth. Families who are using these type of homeownership assistance programs don't use them because they need them. And then we see all of these strings attached that are actually denying them the ability to be financially free and to use their home as a building block for the future. And like Dr. Schuetz said in her presentation, we also need to encourage alternative methods of home buying, of wealth building. So I know this isn't the end all be all, but it has been such a historic and key way for people to build wealth in the United States. So it is something that we need to focus on and also encourage financial education around. So I know that homeownership assistance programs have great the potential to accelerate the wealth building process, but we need to do that in a way that doesn't penalize them. So thank you so much for listening to me today. I am excited to answer questions at the Q&A, and I hope that you enjoyed this presentation. Thank you so much.
Thanks so much, Thalia. I'm going to hand it over to Julian Pierce of the Fairfield County Community Foundation to moderate a panel in just a moment. But I just wanted to remind folks, if you have questions, please put them in the chat window and you can direct them to the host PSC Zoom meeting so that we can collect those, and Julian will help us field those questions at the end. So Julian, take us away to our conversation.
Thank you so much. And we're very gracious to our keynotes, Dr. Jenny Schuetz and Thalia Giraldo. My name is Julian Pierce. I'm the program manager for economic opportunity at Fairfield County's Community Foundation. I'm the host or the moderator today because prior to joining the foundation, I was actually doing a few years work of first-time homebuyer counseling for an organization called Bridgeport Neighborhood Trust. That's kind of how I got my career started. I want to give everyone a reminder that there is a Q&A function at the bottom of your Zoom screen. Please utilize that function to get questions in. After we go through some kind of pre-curated questions, we're definitely going to open up to the audience to ask some specific questions to our panelists. You've had the opportunity to meet Dr. Schuetz and Thalia, but I would like to introduce you to our two other panelists. The first one is Karraine Moody, who is the Chief Executive Officer at Hartford Area Habitat for Humanity. Karraine, would you like to say a couple words about yourself?
Yes, good morning. My name is Karraine Moody. Thank you for the introduction. Happy to be here. Serving Hartford County as well as some areas of Talon County. Truly, I agree with so many of the points made by our featured speakers in regarding homeownership and interest and some of the predatory practices that come into financing as well as even the zoning. So I look forward to these conversations. I think one of the highlights for our program, Habitat for Humanity, we are a nonprofit developer and our focus is homeownership. I think the one area that distinguishes Habitat from other programs is the fact that our mortgages do not have any interest. So we're really working to create homeownership that is truly, truly affordable, but also with as no strings attached as possible.
Excellent. And a quick reminder for our panelists, if you could please turn on your cameras so our audience can see your wonderful faces. And the next person I'll introduce is Chris Troxell, who is the Senior Vice President and General Auditor at Liberty Bank.
Great. Thank you for that introduction. And thank you all for joining this event today. And a big thanks to the partnership for inviting Liberty Bank to this event. And I've enjoyed the presentation so far, and I look forward to our conversation. Yes, my name is Chris Troxell. I am the Senior Vice President at Liberty Bank, serving as a General Auditor. But prior to that role, I spent about 2 years or a year and a half as the Fair Lending Officer at Liberty Bank. And prior to joining Liberty, I spent most of my career enforcing consumer protection and fair lending laws while working for the Consumer Financial Protection Bureau and the FDIC. So I'm very aware of the historical challenges communities of color have faced and still face today when working towards achieving homeownership. But I'm really happy to be part of this conversation today because I know financial institutions play a critical role in expanding access to homeownership and overall in serving our communities as a trusted advisor in helping them along their financial journey, whether it's pursuing homeownership or other wealth building opportunities. And community banks, just like Liberty Bank, serve as anchor institutions in the communities we serve. And our goal is to ensure our communities thrive, and we're here to assist where and when we can. And many times the goal is home ownership, and we understand that those opportunities can build wealth, but there are some challenges as well. And we like to invest time upfront to educate our customers about the home buying process. And we offer various seminars on credit counseling, credit building, and so there's a lot that we can offer besides just granting credit to our communities and customers. And again, we're constantly seeking feedback from our customers and partners within the community on ways that we can better serve our customers and communities. And just like today, I'm looking forward to hearing the thoughts and feedback of the panel.
Excellent. Thank you, Chris. With that, let's dive right in. I want to open it up to for a question that can really be fielded by anyone here on our panel, but what role do you see yourself and your organization taking in promoting housing equity and opportunity through expanding access to home ownership? Anyone can take this question on the panel. Thank you, Karraine.
I'll take the first one. So I know for me personally, we service Hartford County, and more recently in the past 3-4 years, we've been expanding outside of urban areas to make sure that we're moving into high opportunity zones where education programming is available. And also the bigger point for me and for Habitat is where the appraised value, the market value of the homes we're building is substantially higher. So we're looking for those opportunities to actually create equity in the long term for our homeowners.
Great. And Julian, if you don't mind, I'll just add a couple comments here as well. And again, as a bank, as a lender, we are critical to this process. And I see opportunities where we can evaluate performance across the market to see where are their opportunities, where are the opportunities, and what can we do better to serve those unique credit needs of those particular communities. And a lot of times it comes down to analyzing our product offerings to see if there are ways for us to tailor those product offerings to meet the unique credit needs of the communities that we serve. And that could come down to offering a specific product that has or allows a high LTV, a loan to value. And just as Thalia mentioned, with higher loan to value, there comes PMI. And fortunately at Liberty, there are certain areas where we can offer a loan that has a high LTV, and Liberty will take on the burden of paying that private mortgage insurance. So therefore lessening the burden of home ownership to those individuals who don't have a huge down payment. And then, looking at our credit guidelines to see, okay, can we lower our minimum FICO score to open up home ownership to this particular community? And, obviously we want to lend in a safe and sound manner, and, we want to set our customers up for success. So we don't want them to get into a loan that they can't afford, but we certainly are willing to work with our customers to try to eliminate some of those barriers to make home ownership more accessible and more affordable.
I want to pick up a little bit on one of the topics that Thalia brought up, So a lot of the focus on homeownership and especially affordable homeownership is really on the financing mechanism. How can we bring down the required down payment? How we can help people find the down payment and save. But the other piece is on the housing supply, which is, are we building enough homes at sort of the entry-level homeownership? So are we building homes in places that offer people access to opportunity, to good public schools, to jobs, to transportation? And are we building the kinds of homes that are relatively affordable for first-time home buyers to get into? And so a lot of that comes back to some of the zoning and other supply constraints. This is a huge issue across Connecticut, that many of the wealthy suburbs won't allow you to build anything other than a single family detached house on an acre or more of land. That's a very, very expensive home. And so we want to make sure both that the housing market is building enough supply, and particularly smaller homes that are going to be more affordable to first-time home buyers, and that we're doing the work on the financial side and providing the appropriate kinds of instruments for people to purchase.
Thank you. So we're right here. During the keynote presentations, we heard a lot about barriers to home ownership and wealth building for communities of color specifically, including program restrictions and added costs. Karraine, has your organization taken any steps to remove these specific barriers or address them in other ways? And how has that impacted access to home ownership?
So definitely, I think, Habitat is a little unique in the fact that we hold the mortgage and we also are the GC. So we're able to do some really, innovative mortgages where basically our homeowners are basically paying principal, insurance, and escrow. So in the families we serve, we call them their moderate income. We can't say low income because at a certain point, the escrow was way more, just substantially higher than the principal. So we've had to work it out, especially when we go into, more high opportunity zones, such as, into the Towns of Connecticut or the Farmington or Southington areas, where we've had to, really work our mortgages so that we still make sure that the homeowners are not paying more than 30% of their housing towards the mortgage payment. So we're really making sure that we're staying true to those basic, lending practices. I would say in terms of the only string I would say that we typically do is that because the mortgage is 0%, we do have a piece in there that basically says you can sell the house at any time, but you do have to pay off the first mortgage. You do have to make sure that Habitat becomes whole. I think for me, and it's, we don't have PMI. Of course, we don't have PMI. We work with the down payment. Homeowners are able to make their down payment while we're building a home. They have over a year to save towards their down payment. So the program is unique in that, but of course we can't satisfy every single family that wants to be homeowners. So, clearly, we have to continue to work with banks such as Liberty Bank and other entities that allow some of these obstacles to be removed or addressed, or you just have to really think creative. How can we make this happen so that in the end, the family stays in the home, or are they able to do some of those major accomplishments that every American family wants to achieve?
So you mentioned Liberty Bank, so I think it's a natural transition for Chris to perhaps answer this same question. Has your organization taken any steps to remove some of the barriers that prevent buyers of color to access homeownership, and how has that impacted access?
Yeah, sure. Thanks for the opportunity. And on a continuous basis, Liberty looks for opportunities to improve performance and to better serve our customers and communities. And this certainly is a topic that we talk about regularly. And some of those barriers are things outside of our control. For example, if we have a loan product that we're selling to an investor, we have to follow investor guidelines. For example, we use FHA in Thalia's example, and FHA is it's a great product in some respects because it opens up the opportunity for home ownership, but it's a really expensive product. And Thalia laid out all those different costs with the upfront insurance and then the ongoing PMI. But for Liberty, we look for opportunities where we can lessen the burden. And we talked about the Good Neighbor product that Liberty offers, where Liberty will cover the private mortgage insurance. And that's a huge benefit to customers. And sometimes customers don't even realize that benefit until later down the road when they're looking at other loan options where there's an added few $100s to their monthly mortgage payment because of the PMI. So that's a huge benefit or huge barrier that we can reduce. Other barriers that we reduce is, for example, offering closing cost credit, offering discounted loan rates, and then partnering with community organizations on community seconds and allowing borrowers to use those partnerships to put towards the down payment and therefore lessen the overall cost of credit to customers.
Thank you, Chris. And you mentioned Thalia and her great research, and I can already tell that a lot of our audience is excited to dig into that research. With Thalia, I'd like to ask you a question. We heard a little bit about the tools that are available to help households who are looking to move towards homeownership. Is there anything that hasn't been mentioned that you can think of that came out during your research in terms of tools and support available for households looking to become homeowners?
Yeah, so I actually, I don't think I spent enough time on this, but I do want to point people to the database that I did create with the partnership. So at some point, maybe we can put it in the chat, but this report really came out of that database. So in that database, you'll be able to see all the different homeownership assistance programs. And I definitely want to add additional ones, right? But the assistance programs that I was looking at that time, and they're separated based on whether they're local or national, but you're also able to see upfront what the different requirements are. So whether you are, I think someone had asked in the chat, what are the assistance programs that would require you to stay in a specific geographic location? You'll be able to see that upfront before you even go and do additional research. I put that up front, whether you're required to stay in the home for a number of years, whether you're required to live in a specific neighborhood or stay with that employer. So I just want to point people to that database in case they do want to see the full array of, yep, they just linked it in the chat. So they can see the full array of housing finance programs.
Fantastic. Dr. Schuetz, you as well, through your work and your research, have you come across any tools and support available for households looking to become homeowners that haven't been mentioned today?
No, I mean, I think it's worth reminding people that, there are lots of programs that are out there, and it's important when you do research to think about sort of what your goals are, right? This question about how long do you intend to stay in the house? And that's really important in thinking about whether or not a family wants to buy a home or rent a home. In general, if you're planning to stay in the home for a short period of time, then the upfront costs of buying can be quite expensive. And so for younger households who may be thinking they're going to change jobs or they may change their family situation, right, renting may actually be the better option. So think about sort of what your larger economic goals are. And the other thing is that it's really important to make sure that you're working with a trusted institution. So both on the lending side, if you do homeownership counseling, right, there are HUD-approved homeownership counselors who are really interested in helping people understand their finances and improve them. But you sort of want to make sure that you're getting advice from somebody who has your best interests at heart. And so do your homework before you find, organizations like Habitat are all over the country. And so, organizations that have sort of a long history, and you can kind of do your research and make sure that, that they have a good history of placing people in long-term homeownership.
We're going to pivot slightly to somewhere I know our audience like us to go, and that's policy. And Dr. Schuetz, we can stay with you, but anyone feel free to answer this one. But what systems-wide policy changes need to be made in order for progress to occur in this area? And is there any movement toward these changes that some people may not be privy to?
Yeah, there are sort of a couple of areas where policy change, I think, would be really important and useful. We can start with maybe the financing side. So the federal tax subsidies, as I mentioned, are very much set up to help higher income households. There were some really big changes that happened in the 2017 Tax Cuts and Jobs Act, in particular, raising the standard deduction. So most households in the US now just take the standard deduction and don't itemize. You only get the benefit of the mortgage interest deduction if you itemize your taxes. And so that's primarily for people who earn high incomes and face high marginal tax rates, and who have expensive houses, so that they're paying a lot of mortgage, right? So there's one of the common misconceptions is that every homeowner gets the benefit of the mortgage interest deduction, and that's not true. It's at this point a minority of households who actually get any benefit, and the vast majority goes to really affluent households in very expensive houses. And so, given that that's a very regressive tax policy, a better use of federal money would be not to subsidize rich people, but to use that money for targeted first-time homebuyer tax credits. And the Biden administration has had some proposals about providing first-time homebuyer tax credits. That's also really important if we're thinking about opening up homeownership to households that typically have been discriminated against. Providing more of this down payment assistance without people having to take out a special loan to pay for it would be really helpful for families that don't have family wealth and generational wealth. And so that would be an important change. The other sort of systemic changes really are pushing back against these restrictions, these zoning regulations that make it hard to build first-time homebuyer appropriate homes, right? And at some point, we should probably come back and talk about, what those structures look like. In expensive cities, a single-family detached house or even a row house is going to be very, very expensive and out of reach. And we need to start thinking more about things like condos being first-time homebuyer. There's some extra challenges that come with that, because in addition to the mortgage payment, you also have a payment to the condo association, and that's generally not financeable. And so there are some special kinds of tricks, but the purchase price on a multifamily building, a unit multifamily building, is going to be generally much lower, especially in these very expensive housing markets. And so that needs to be part of the conversation.
Thank you, Dr. Schuetz. Anyone else have any perspective on policy specifically, and what changes in policy need to be made in order for more progress to occur?
Yeah, if I could throw in, I would say this, one of the things I've realized is that as a society, I really, really appreciated all of the legislative wins that we sort of were able to achieve this past session. And even, desegregate Connecticut and all of the other zoning conversations. But I do think at the grassroots level, there needs to be a conversation at every town, because even for instance, Habitat for Humanity, even when we go into these other areas and we want to build single family homes, the surrounding neighbors have such objections to affordable housing. And in many cases, it's not the town itself, it's actually our neighbors, it's actually within our culture, within our region. And so, the attitude or the public policy around affordable housing, there's so many stereotypes surrounding it, and there needs to be some form of a campaign to address that. Because, when you go to a town, and I don't want to name towns, if you go to a town, two towns outside of Hartford, and you're dealing with just straight, blatant racism or, socioeconomic classism, you're shocked. But the reality is that it exists. And so collectively as a state, 69 towns is crazy and ridiculous. But the reality is, as a state, we do have to have this conversation, because it has to happen that if folks are paying rent of $1,200 for a 2-bedroom flat, that's a mortgage payment. Every day, all day, that's a mortgage payment. So at some point or another, we do have to have this conversation about affordability, just housing affordability, period, because it continues to happen. And I've, 7-8 years in the role, and every town we're constantly battling this, and it's really it's a policy level, it's in the zoning guidelines, but it's also grassroots, and it's actually like person to person. So there needs to be some form of a campaign at the local level to absolutely deal with some of the stereotypes and issues that we tend to foster within our towns.
It's good that you mentioned kind of local opposition to home ownership, which is a major barrier, but it also a good transition into another thing that is maybe more new as a barrier in the last several months, which is the demand for housing. And I'd like to open this up to the entire panel, but can you provide some thoughts on the current demand for home buying and inevitable increased prices for purchasing? A little bit about how that might impact affordability and access to home ownership for households that have already been historically precluded.
Yeah, well, Julian, I'll take a first stab at that. And you're right, it's definitely a seller's market right now. So prices are rising. And if you're buying in this market now, you're likely paying a premium. And the downside or potential drawback is over the next year or so, you could see the value of your home decreasing, and therefore putting you potentially in jeopardy of being underwater in your home. So, certainly we want our communities and our customers to be aware of the fact that this is a seller's market and to be cautious and careful when going into negotiations for a home, and to not, waive certain contingencies, or to be careful about how much they're willing to offer on these properties. So that would be a caution to anyone really looking to buy in this type of market. And again, it's a seller's market, and you just have to be cautious and aware of that.
Yeah, I mean, Chris brings up a really good point, which is that when we get to this point in a home buying cycle where there's very strong demand, lots of people want to get in, you may be competing against other bids. There's a tendency for people to sort of panic and think, if I don't buy now, I'm never going to be able to buy, and I should do whatever it takes to get into the house and to buy. And we do hear more stories about people, for instance, waiving contingencies on something like the appraisal or the inspection. Really, really, really be careful about that. The inspection is there to make sure that the house is fundamentally sound, that the condition of it, that you don't buy a house that has major maintenance problems that are going to come back and bite you as soon as you get in the door. Waiving the appraisal is also risky if you don't have extra cash to make up the difference. So it's a really tough situation because rents are going up, and so renters want to have the stability of knowing that they have fixed payments with a home. Prices are also going up, so it's not that one of those is clearly better than the other one, but it's really important for people to kind of have patience and take a deep breath. Ultimately, some of this demand is driven by just the fact that we've got a lot of millennials who are reaching peak home buying age. There's a big generation of people who wants to buy their first house, who are expanding their space. And at the same time, we have this huge generation of the baby boomers who are still living in their homes, who aren't quite ready to sell, to downsize, to relocate. And so, these are sort of fundamentals. There are just a lot of bodies that need places to live. And we haven't been building enough homes to keep up with it, especially in the places that have great jobs, great transportation and schools. So, we're going to have to tackle both sides of that. But it's important not to get caught up in the psychology of kind of the rush and wind up making a mistake.
If I could just add on to that too, I think, Jenny, you bring up a really good point, because that is a perfect storm of when people start to stack up these different homeownership assistance programs, which then lead them into really high monthly payments. So, at using one of these programs, having PMI tacked on to your mortgage payment isn't terrible, right? It's part of being safe and making sure that people can actually afford their homes and are being responsible. But then when we start to stack up these different things and we're seeing the additional cost over time, that is the actual problem that I was hoping to get across, and is really taking people or pulling people back. But again, like you said, Jenny, people are sort of rushing. They want to buy a home. They're excited about it. They feel like it's something that they need to do in their life, and in an effort to do that, end up getting really bitten by that in the end.
Thalia, can we expand on that a little more? And I believe this is a question that actually came from the audience, but do you think multifamily home ownership as a wealth building option is realistic for today?
Yeah, so I think that's fantastic. So actually part of the research that I was doing was looking at multifamily homes, because multifamily homes are really more affordable for folks, right? You're getting rental income that is assisting you in your mortgage payments. And oftentimes it's easier to qualify for a multifamily home. And I think someone had mentioned house hacking, which is when you are buying a home and then getting rental income. So I think it's a really great way to be able to actually afford your own home. But then again, right, house hacking often gets said as the golden ticket, right? Just because you are house hacking and you are having someone renting your home doesn't mean that you're going to be living for free. There's additional maintenance costs. There's all these additional costs. So I think that looking at things in an overall perspective, making sure that you're financially stable and have money in your piggy bank to be able to save for a rainy day is really essential. But I do think multifamily homes, because they're so much more affordable for people and give them the potential for financial stability through the rental income, really need some more attention.
I'll just say, in some ways, we're seeing a little bit of a throwback to a couple generations ago. If you think about like the triple deckers that are really common across the Northeast, or the duplexes, sometimes that you would buy the whole thing and then rent it out to somebody you didn't know. But those are often also ways for multi-generational families to live together, right? So if you have a duplex or a triple decker, that you may have, 2 or 3 sort of independent family units in a larger family that can pool their resources collectively to buy that. And we're actually seeing more interest in multi-generational families living together, buying homes. This is something certainly that Fannie and Freddie are thinking about also on the underwriting, that if you have more people who are workers living in the same family and contributing, how does that feed into the underwriting, right? So if you have a sibling or a cousin or somebody who's going to be sharing the mortgage, to make sure that there's a way to account for that additional income. And that, particularly in expensive areas, if you have, additional family members, that's a great thing to think about. And again, we want to make sure that there are enough of these sort of duplexes, triplexes that are available, that are really well intended for those kinds of purposes.
Yeah, if I could add one thing, I think I totally agree with the transition back to multifamilies. I know, Habitat in particular, we did 3 duplexes in North Main Street, and it was well received. The interest and the families that wanted to actually cohabitate between multiple generations, it was seen as a plus. I know also another developer, Toro, that they also are doing multifamilies, and it has been really successful in the Brackett Park neighborhood. So there is value in what the past did, or what historically it did for families. I know I'm coming from living in Miami and then moving to Connecticut, and I remember when I first came to the Blue Hills neighborhood, there were tons of multi-generational folks living in these multifamilies, and it was, one, financially savvy for the families to have that additional income, but 2, it was also community building and neighborhood security as well, because if grandma and grandpa is on the first floor, you can't skip school because they're going to see you, so there's so many other pieces. I'm just being comfortable, but there's so many pieces to, that trend. So I do look forward to seeing that in more of our suburban towns, as well as a continued revisit to the rehabs that are available in urban areas that are ripe for the opportunity to have multi-generational ownership within its means, between, even if it's owner occupied with a rental, whatever it is, it still will bring value to our towns and our neighborhoods.
Thank you, Karraine. And audience, we've transitioned directly into our audience Q&A, so please keep those questions coming. Chris, I see you unmuted yourself. Please add some thoughts.
Yeah, I was just going to add that, financial institutions, community banks, we, support financing of multifamily properties, but we also, specifically at Liberty, we finance the rehabilitation of those types of properties, because I think the panelists have already mentioned that in Connecticut, the housing stock is somewhat aged, and some of these properties need work, need some rehab in order for it to be livable. So what we do is we provide financing for the purchase of the property, but also give funds to the borrower to rehab that property to make it more livable, or to make it livable. And I think it's important to invest money in that rehab work, and then also provide funds to communities or builders that want to create affordable properties, whether it's single family or multifamily properties.
Karraine, earlier in the conversation, you made some good points about policy. What might you say to a person who suggests or believes that regulatory and/or policy changes are actually not the answer, but rather market forces alone should be allowed to usher in equitable access to housing?
So, you know, my first response is that if it's not policy, it will never happen. And the reality of it is the same way how we have, you know, the same way how we have so many issues around, you know, bias in the homeownership process and the financing process, unless there's a check and balance, it won't happen. And if we're just depending on the market to correct itself, the reality is at this point right now, so many folks of color, so many, you know, working class families can't get into the market. They can't even afford the basis of a single family home because it's 200 plus. You know, so I do think it requires multiple approaches, multiple strategies to get to an equal playing field, or at least to get to a balanced approach. It can't just be one or the other. It has to be both. And I do think, you know, this webinar sort of highlights all of the pros of homeownership, but it also highlights the cautionary tales that when you go into the process, that you have to be knowledgeable, or you have to have an ally that speaks the language that's going to help you get there.
Another question for the group, and thank you, Karraine. Sticking on the topic of equity, race equity specifically, what recommendations might any of you have for families to avoid racial discrimination in the home buying and appraisal process?
Yeah, I mean, that's a really difficult one. And, you know, I will say, I don't think it should be the responsibility of the individual home buyer to have to get rid of discrimination in the home buying process and the appraisal process. You know, this is the role of government, right? The government is supposed to be there to enforce existing fair housing laws. We have laws on the books that make it illegal for realtors to steer Black families and white families to different neighborhoods, but we know that it still happens, right? So we have not put enough resources towards enforcement and consistently enforcing that. This is, I know, a strong priority of the Biden administration. They're trying to reinstate some of the rules that would allow them to push more aggressively at this. But, you know, that is the role of the government, to make it as much of an even playing field as possible in the process. That still doesn't make up for the historical gaps in wealth that have been accumulated in large part because of past policies, right? So the government policy created racial wealth gaps. It's also the government's responsibility to get rid of that, right? So I think we need to hold policymakers to account and make them do their jobs.
Yeah, and I would just add, as a former compliance examiner, we did that. We went to institutions and evaluated them to see if they are following the applicable fair lending laws and regulations. And, you know, sometimes there are bad actors out there, and hopefully over time, you know, we can weed those out. And like you said, the federal government has to continue to examine institutions to ensure that they're following the applicable laws and regulations when it comes to fair lending. And Julian, to your question about what can consumers do, you know, maybe one step or one strategy is to potentially do some shopping and to talk to different lenders. And then from there, you get different perspectives, different kind of options. And I think having those options available to you will give you some insight on whether or not you're getting a good deal, or whether or not one lender is treating you differently based on, you know, the way you look or what your name is. And I think that's one strategy. And then another piece is, even before getting into the home buying process, look at the banks in your area and find one that has a good reputation of serving the community. And I think that would be another strategy consumers can take to potentially avoid that unfortunate circumstance of being discriminated against based on, you know, the way you look or what your name is.
So we have another question. It is multifaceted and it is very specific. So I will extract a portion of this question, and it's from an anonymous attendee. But they would like the panelists to address the competing interests of home buyers versus renters. And the specific question I'll ask is, does building wealth through homeownership rely primarily on increasing home value over time? And then another part is, how do communities help build wealth in homeownership without burdening tenants in the rental market who may see increased rents without substantial increase in the diversity of the housing stock? And that can be for anyone.
Yeah, so I'm happy to take a first crack at that. This is a great question, and something we don't talk about directly enough, which is that people who own homes and people who rent homes have different financial interests, right? If you already own a home, you want the value of the home to increase over time and to increase more than the general rate of inflation. If you are a renter, you do not want property values to go up because your rent goes up. And so this is really a tension that I think should come out more in things like local elections when you're voting for your mayor or your county supervisors. They're talking about keeping rents moderate, or they're talking about trying to improve the property values. That implies different things. Historically, house prices across the country have risen sort of with the rate of inflation overall, and a lot of the wealth building is really just this forced savings mechanism, so that you're paying off your mortgage over time. But the house doesn't have to go up by 15% a year for you to build wealth. It just has to rise at the rate of inflation, and you put aside money by paying down the mortgage. Since about 2000, we've seen in a lot of places housing prices going up much faster than other goods and services. And so people are able to make a lot of wealth just by sitting in a house that they bought in the right place at the right time. And that is, of course, a very dangerous situation for renters, because they are, not only do they get priced out of buying a home, but their monthly housing costs are going up really fast. So we don't have to have that situation to build wealth. But again, I think it's also important that home equity shouldn't be the only way that people build wealth, right? Put some of your money aside for a down payment to pay off your mortgage loan. Put some of your savings aside into a 401k, right? Into another form of wealth building. There are parts of the country, places like Baltimore and St. Louis, where housing prices have actually gone down over the long run, and people have paid off their mortgage, and the house is worth less than it was when they first bought it, right? So you can't count on housing prices always going up. That shouldn't be your only nest egg for retirement.
It's good you mentioned that, Dr. Schuetz. A lot of people have been asking about savings as a mechanism for wealth building rather than just investing in a home. But I will take one more question from the audience before we just take some final thoughts from our panelists. And I want to thank you all again for such a robust discussion. But does anyone have any suggestions that we could perhaps provide to our local municipal planning and zoning committees to help counteract some of these barriers to home ownership that we've discussed today?
Make it legal to build all kinds of housing everywhere. So you ought to be able to build attached row houses, duplexes, small multifamily buildings. Those should be legal everywhere. There's no reason to prohibit those. Also, just make the process of building homes quicker and easier, right? So Karraine should be able to go out, Habitat should be able to build a house quickly, right? Should know the process from start to finish. It should be transparent, should be a level playing field. If we built more homes of all different kinds, then we would enable more diversity in all of our communities.
That was perfect, Jenny. Perfect. You hit it right on the nail. I don't have to say a word. You got my vote.
I would also add, some of the questions that I referred to at the end about really asking whether the homeownership assistance programs, whether an exchange needs to be involved in that way, right? Like, are the things that we're asking people to do in exchange for this money really necessary? Or do we not trust people to do something with this money, right? Like, why is it that we're making it so difficult for people to access $10,000, $12,000, whatever it is for the down payment of a home that doesn't even cover the full amount most of the time? So just really asking that question about whether it's necessary to add that certain requirement.
And we are coming to a close. I just want to open it up to our panelists. If there are any final thoughts that you'd like our audience to take away with them as they leave us today, please feel free to share. Chris, Jenny, Karraine, or Thalia.
Great. Well, I'll be the first to kick it off. Well, I just want to thank everyone for inviting Liberty here and appreciate the conversation. And I would just leave the group with the message that your local bank is willing to help you, and we are the trusted advisors that we want you to come to, and we want to work with you to help remove or lessen the barriers to home ownership. And I know at Liberty Bank we do everything we can to help you, and that's exploring all options. And if there's a deal to be had, if you can get in there, we want to help you achieve that.
Yeah, I would add that, I'm very grateful to be on this panel. I think that we summarized it well in saying that homeownership is just one way to build wealth for your generation and the next one to come, but that you have to explore every single option. Homeownership may not be for everyone. It may not be for, we see that every day. It may not be for everyone, but whatever it is that's going to get you to some level of stability for you, yourself, your family, you want to do that and find an ally that can help you navigate that process. Even if it's not home ownership, find an ally to help you, create a savings plan or an investment plan or a strategy so that when you get into your latter days, it will be what you expect and what you dream it to be.
Yeah, and I'll just say thanks for putting on this panel. This is a really useful conversation, and I love that this is a balanced panel and that we're talking about both the pros and the cons and thinking about sort of the larger picture. Often the discussion is just, home ownership, that's everybody's goal. And, it's great to be a renter too, right? Renting offers you some flexibility. Almost all of us are renters at some point in our life. And, I think we should just get comfortable with the idea that there are lots of different lifestyles and those are all good. And we should have policies that support people to make the housing choice and the location choice that fits their lifestyle and their budget, and let people then choose what fits their needs and their family's needs.
Yes, thank you all for being here, and the panelists as well, Karraine and Christopher, and Jenny, thank you, and Julian as well for the great moderation, the great conversation. And again, I think it's so important for us to, Jenny, like you said, to diversify how we build wealth, right? It's not just about home ownership. It's an important piece because it's been so important for so long, and we can't neglect that. But we do need to increase financial education for people of color to allow them to see what other streams of income they could have, how they can build their nest egg for the future. So thank you for all of that input. And I learned a lot as well today. So thank you so much.
I want to take this opportunity to not only thank the panelists, but thank the audience. We can't have this conversation, this robust discussion without you, without your eyes, your ears, and without you out in the community sharing some of this great information with the folks that you serve, that you work with, that you interface with or interact with in your daily lives. So with that, I will conclude the panel portion and pass it over to Kylie to formally close us out.
Thanks, Julian. Thanks to you and the Fairfield County Community Foundation for sponsoring us in this work, along with the other sponsors I noted at the beginning of the presentation. Thanks for everyone for joining. This is a great conversation, and I hope as we often say in these, it's just the beginning, but there's so many different elements here that we could take and create a whole separate forum on. And so I know that we'll continue to do that here in the partnership. If there are topics you're interested in hearing about, we're always looking for new ideas or something you're interested in even hosting yourself. Please just let us know. Feel free to reach out to myself or anyone at the partnership. This presentation, for those of you who, like me, are thinking, oh, there's so many people that I want to hear the amazing research and ideas that you all shared, is going to be available on our website shortly, along with, as some of you requested, the slides, so that you have access to those. And I know that if you scroll a little bit up in the chat, since there's a lot of really nice comments going on right now, you'll see, I think Kaylee or PSC Zoom meetings posted a link to Dr. Schuetz and Thalia's most recent pieces, which are available by those links and also on our website. So thank you everyone for joining us today. I hope you all have a great week. We look forward to chatting more with you about this and other future topics. Thanks again, everyone. Have a great day.